Today. It's the start of March Madness, and we're going to give you some insurance madness today, maybe. So I appreciate you guys being here. This is a monthly series that we do called our Coaches Corner. We generally do these on the third Thursday of each month at 1 o'clock, not always, but usually. We do record all of these sessions, so to the extent that you missed something in the past, you can certainly reach out to us and we're able to review that effectively on demand. To the extent that you would want a particular topic covered here, you could certainly reach out to Andrew or George or myself. I mean, we do try to cultivate these to be very meaningful. So if there's something that's on your mind, you could please reach out to us. We'd be happy to entertain that and potentially accommodate you. So today, in the next about 45 minutes or so, we're really going to be talking about some estate planning maximization and protection strategies, right? And describing how we can do this type of work. If you have tuned into these coaches corners before, you know that really what we do at USAdvisors is we really help wealth advisors intentionally integrate insurance into their wealth advisory practice. And the way to do that intentionally, at least from our point of view, is to really, first of all, identify the person or the people that we need to be talking to. And if we can identify those people, then we need to be able to have a good conversation. We call that positioning. So it's really around finding the right kind of client or prospect to have the right kind of conversation with. And so today we're going to attempt to hopefully identify a couple of clients or prospects that you might have that we ought to have an insurance planning conversation with, right? That's fundamentally different than people who need to buy insurance, because again, another thing we do here is we really focus on what insurance does, not necessarily what it is. And so we love working with wealth advisors who are doing comprehensive financial plans, because then we can get our clients into the green in retirement. We can congratulate them and we can ask them, have you considered what could keep your plans from coming to fruition? What could potentially break your financial plan, right? And then helping them understand what their options are to bring some protection and eliminate some of what I consider to be shrinkage, right? Dying actually has some costs associated to it. We're going to talk a little bit about that today as well. And so please keep in mind people that you're seeing today, or maybe you saw yesterday or in the next week or month, that you might want to have similar conversations with. You might want to jot down their names. And to the extent that any of this resonates with you, you could reach out to Andrew or George or myself, and we'd be happy to help you on that basis. All right, so with that, we're going to kind of get started. As I described a little bit of the plan, you know, at the end of the day, I want to understand how can we mute or minimize the cost of death and the cost of care, right? Because these are the things that are effectively going to blow up financial plans. And they're also the things that limit or reduce AUM, right? To the extent that we protect our clients' money, well, then your money ends up being protected through the AUM charge, right? So long-term care insurance is a good example of that. I call that retirement portfolio protection, right? Because that's really what we're doing. We're protecting the retirement portfolio. And then I also call it AUM protection, because ultimately, if your clients don't have appropriate long-term care protection and they need long-term care services, where's that money going to come from? There's a very good chance it's going to come from your portfolio. And what if it comes from your portfolio in a down market, right? So this is that idea. So we just want to be aware of these things and have better conversations. And so we also want to discuss, you know, how can we effectively better position and even utilize life insurance as an asset class? So many people, when they think of insurance, are just thinking about what it costs. And whatever it costs too much. And I'm not going to pretend that it doesn't cost too much, but I'm saying, well, that's almost irrelevant, because we can actually put together structures that create assets, and we can actually do the math on those assets and determine what kind of return we get. And you might be shocked, I know a lot of clients are shocked at what kind of return you can actually get inside of an insurance contract. And you can get that return often on a guaranteed basis, often with non-correlation to the market, and an income tax-free distribution. Right? We can also place it in an irrevocable trust and keep it away from estate taxes as well. So life insurance tends to be a very powerful transfer tool that often gets ignored by clients and advisors alike, because they think they don't need it, or maybe they don't want to talk to an insurance company or an insurance person. I'll tell you that the clients we can help the most, in my opinion, generally do not specifically need the insurance products that they place. They generally want them because they understand what's at risk and understand how it can fit into their overall portfolio. And I do a lot of joint work in these areas. And so I meet with clients every day, and I have done so for about 25 years. So what I understand is that if we have a high trust relationship and we have the right context, which is the financial plan, and then we can give them appropriate education on the good, bad, and ugly, and what are our real options here, right? And how would the insurance solutions work? And we can get our clients to really consider what we're talking about, then we have a really strong chance of them ultimately implementing. And in my practice, more people do implement our recommendations than don't. And that's due to the high trust relationship with the advisors that I'm working jointly with. And then it's also due to me and my team hopefully having a really sharp saw in these areas to kind of carve out almost a special project inside of the financial plan. In order to do this right, we do have to have good conversations, as I've described. That last bullet point there is something that I really believe. Insurance needs to be addressed by touching the heart before the mind. Okay, so much of clients and certainly the wealth advisor class are looking at the math, and the math is very important. Anyone who says the math isn't important is wrong. But you know what also is important is how people feel about things. And we need to understand the intersection between people's emotions and what the math is. And relative to any insurance planning, if we just strictly ignore the emotional piece, we ignore that heart, we're going to have very little success because we're always going to default back to, well, it's too expensive. Right? When we get into the heart-based questions, it's about what's really important to you, right? And how do you feel about things, and which mistake would you rather make, right? And now we get into understanding what are the compelling reasons why people would want protection. And if they do that, then we understand what motivates them. And so I'm a good example of that. I have life insurance. I have disability insurance. I'm looking at long-term care. I'm 46 right now. I haven't pulled the trigger on that. But I don't have insurance because I like insurance or because I'm an insurance agent. I have insurance because I made promises to my wife that I care about. And if you were going to be an advisor of mine in any way, shape, or form, you've got to be able to uncover what I really care about is I really care about the promises I made to my wife. Okay? I don't care about insurance. Now, what insurance does for me, and by extension does for my wife, is creates a funding vehicle for those promises. What are those promises? Generically, the promise is that if I'm not here today or I become disabled, that my wife's lifestyle doesn't have to change. That's basically the promise. And how I'm fulfilling that promise is the one-time buyout of the life insurance proceeds because my ability to earn an income would go away, or through disability coverage. And so when I started in 2000, Northwestern Mutual used to call it live, die, or become disabled. And what they would say is that we want to have a plan for you that works whether you live a long time, whether you die early, or become disabled along the way. And that may be very simplistic. It may even be salesy, but in a certain way, isn't that really what we're doing? Isn't that what you're doing as a financial advisor? So if you're not addressing all of those, then maybe we're an investment advisor more so than a planning advisor. Not that there's anything wrong with that, but if we're just managing money, then we're helping them as long as things go well. Well, how often do things go well? Most of the time, right? There's that saying that man makes plans and God laughs. I mean, I'm getting to the age where I see that happen a lot more. I got plans, and then, you know, life has different plans for you. So again, it's about risk. Do we have a risk? How do we feel about that risk? And what are our options to minimize that, right? And so we're going to talk through that in that kind of context and that kind of tone. Pulled a couple of nice articles here. If you want to see either of these, reach out to us. We'll prepare that for you. Forbes had a nice article that I think has this nice bolded piece here, right? You can draw up all the documents in the world, but if they're not funded, then it's like joining a gym, buying new sneakers and workout clothes, but not actually ever working out. And so what we really have to do is we have to have a plan, but then we have to know how we're going to fund that plan. And so often we're jumping right to the insurance. Well, it's not about insurance, it's about having a plan. What's your plan, right? So we got to stay at what is the plan. And then we ask, well, how are we going to fund that plan? If we do that, well, now we get consideration for funding that plan with insurance. And by the way, we can demonstrate the math that might be very favorable, and might be more favorable than you're even thinking. And I'm going to show you some of that math here today. Another good article that we have linked here was one by Merrill Lynch. And so, you know, the bolded here's are, you make a plan, but a plan is not an event, it's a process. Right? So we put together a plan. It's like a breathing plan. And like any plan and any process, it needs to be revisited and it needs to be flexible, or at least flexible enough. And so this is how we attempt to have this conversation, right? And then at the end there, we don't want to let the tax tail wag the estate planning dog. Well, what are they talking about there? Shrinkage. Our best clients are subject to income taxes, estate taxes, state estate taxes. Are they aware of this? How do they feel about this? And do they want to learn more about potential opportunities or solutions that can minimize those and increase the likelihood of success? So we've alluded to some of these, but what factors effectively can reduce our legacy value? We have estates that are subject to federal estate tax. Well, if you're on this call, you may be aware, and probably are aware, that we're having an estate tax rollback in 2026. So that's like 22 months from now, 21 months from now. That's going to go by very fast. We've talked with some estate planning attorneys around this, and they're already getting very busy, and they're expecting that that they're going to be extremely busy, and suggesting that people do not delay. Most people tend to want to delay. If we end up delaying into the fourth quarter of 2025, there's a good chance you may not have the estate planning attorneys that can draft the documents because they're expecting to be really, really full. But what we have to understand about the federal estate tax rollback is that it's being cut back approximately in half to around $5.5 million a person if laws don't change between now and then, which they could, and we're in an election year this year. What that really means is that there's a bunch of clients out there that haven't been thinking about estate taxes for a long time, and advisors haven't been thinking about it. And now you might find that a lot of these people are sort of scooped into this that weren't before. And so we want to be aware. So you might want to consider, who do you have that has a net worth of $10 million or more, or approaching it? Those are people that maybe should at least be aware of this, and maybe we ought to start a conversation. Now that's the federal estate tax. Well, some states have a state estate tax, like Minnesota. And the state estate tax in Minnesota, I believe, is pegged at $3 million. So you have anybody with over $3 million, well, they're subject to a state estate tax. Are they aware of that? Do they care about that? How do they plan to pay for that? And would you like to understand other options that your peers may be utilizing, right? Estates that lack liquidity. Well, that's sort of generic, but what kind of estates could those be? Well, those could be those that have a closely held business, right? Call it a micro stock. Maybe they have a large real estate portfolio. Maybe they're a farmer, right? So they have assets, but they lack liquidity, right? And so if you're a farmer, for example, and you're subject to the state or federal or both estate taxes, where's the liquidity going to come from to pay this? Are we going to have to sell some acres, right? Start talking to a farmer and ask them how many acres you would have to sell to satisfy the tax burden, and see what happens, right? You speak their language. Well, they're not, that's a family asset. That's a family farm, right? They're not selling any acres. Well, they have a liquidity issue. Right? It's a good issue to have, of all the issues that you can have, but these are people that need to have a conversation, in my opinion, around the strongest and most powerful transfer vehicle available, called life insurance, right? By the way, it solves the problem at the right time. What triggers these two taxes? Death. It's actually the second death, right? First death of an individual can pass unlimited amount to the spouse. It's at the second spouse that these estate taxes are due. Well, now both spouses are dead. These costs are now triggered. Well, you know what else is triggered? The life insurance. What is life insurance? It's really cash. At the very end of the day, it's cash. And so that is going to give us the cash. It's going to give us the flexibility and the liquidity we need to pay the taxes that might be due, right? Clients that require long-term care services. We addressed this a little bit at the top of the hour. I happen to believe that the most important planning that we do is around long-term care planning, which I call retirement portfolio protection. The fact of the matter is that some of our clients are going to have a cognitive impairment and are going to need 24-hour care. I'm an optimist, okay? But some of our clients, that's going to happen to, and they're going to pay $15,000 or $18,000 a month for 7 years. And where is that money going to come from? Other clients are going to have a care need at home for 3 years, and it's going to be $6,000 per month. Right? Part of what makes it tricky is we don't know what's going to happen, but then people want to be in denial that it will never happen to them, and they certainly don't want to buy insurance, which is why they need someone that they trust, like their wealth advisor, to say, hey, you know what? It's a little distasteful to think about, but we definitely need to discuss this because we need to have a plan for what's going to happen. You don't have to have insurance. We need to have a plan, and then we need to understand what's going to fund that plan. And if we get to that level, we have to consider whether insurance should partially or fully fund the plan. And if we get to that level, people start realizing, boy, insurance can be really amazing as part of the overall portfolio, which again, I'm teasing you just a little bit, but I'm going to show you some numbers and some examples on this. The last bullet point there is estates with large qualified accounts. Well, what am I referring to there? I'm referring to the non-spousal inherited IRA rule, right? So non-spousal inherited IRA, if I inherit an IRA today, that's the worst asset for me to inherit today. Why is that? I told you I'm 46. I'm going to have to take that within 10 years. I'm going to have to take that on top of my already earned income, which means I'm going to pay at my highest marginal tax bracket for those distributions. By the way, that retirement account that I inherited in this example, I really want that to feed my retirement. I don't need that money here today because I'm working, right, and have a good practice. But I'm going to be forced to do that, right? And so what's the cost going to be and what's the shrinkage? And Mr. and Mrs. Klein, are you aware that that's going to happen? How do you feel about that? Right? It's particularly important if these clients are in a pretty low tax bracket, your clients who might be 70 today, and we talk about their kids inheriting. Well, who are their kids? They're 40, 50, 60 years old. So it's particularly interesting if the parents have a low tax bracket and the kids have a high tax bracket. So these are good conversations to have and good things to consider. But these are really the factors generically that are going to be reducing or shrinking our account values, okay? So what about this question, like where are taxes headed, right? We know that estate taxes are moving backwards. I happen to think that income taxes are moving up. Why do I believe that? I really believe that for a couple of reasons. Number one, if you were to look at historical income tax rates in the history of the country, you would find that we're historically about as low as we've ever been in this country. We've had marginal tax rates of over 90% after the war. We spent a lot of time in the 70% range in the top market. And we're historically low. The second reason is this debt clock that I'm going to show you in a second. I don't know if any of you have seen this debt clock. It's a little busy, so if you get dizzy looking at stuff, you may want to look away. But this is USdebtclock.org, and there's so much information here. I'm not going to attempt to grab all this. I just want to highlight a few things. Right here on the left is the U.S. National debt, $35 trillion. Okay, is that a big number? It's so big, I don't even know how big that is, right? Well, they said, okay, this U.S. debt, if we divide it by U.S. citizens, that's $100,000 a person. That's how big the debt is. Okay? But guess what? If it's per taxpayer, the debt is $266,000 per taxpayer. Again, you still don't know how big this is. But look at this, they have this time machine. So 35 trillion almost. Let's go back in time. Let's go back in time 2004, 20 years ago, right? 7.7 trillion. That's a huge run up, right? What is it projecting 4 years from now in 2028? 46 trillion. How are we going to pay for this? I looked at a chart on Twitter, so it had to be true, you know that, just last week, indicating that over half is going to just debt repayment, right? And so my belief is that taxes are going to go up. So why do I even bring that in? I go, well, here's the things that are limiting our clients' legacies and portfolios today, and I think we're going to be even more limiting in the future. Okay, a good example of that for me personally, as I have my own corporation, I actually fund my Roth 401k. I don't fund my traditional 401k. Now I know who I'm talking to. I'm talking to the wealth advisors. It is very painful for me to fund the Roth IRA today because I could be getting these beautiful tax deductions today. Okay? But the reason that I fund the Roth IRA is because I firmly believe that my taxes in retirement are going to be higher than my taxes today. Now, is that going to be the case? Well, we're going to find out, but that's the bet I'm making. And I'm doing that with pretty good income here today as well. So I'm foregoing significant tax deduction today because I believe the cost in the future is going to be higher than that. And I want as big of tax-free buckets as possible. I also put $1,000 a month into 2 different IUL contracts that I own. So when you look at what my strategy for retirement is, most of my money I'm planning to come from my Roth 401k, which will ultimately be a Roth at that time, plus money from my own life insurance contracts. Okay? Now, am I going to be right? I don't know, but it's something worth talking to your clients about. Are you aware we're in a historically low income tax environment? Are you aware where the debt stands today and what it's projected to be in the future? How do you feel about that, right? And would you like to learn some strategies that other people are utilizing? Right? I think that's the way to go about this. All right. This is a question that I think is interesting. Is it valuable to know the ending value of an asset at death? Is it required to know that? No, probably not. You're managing money for a client. Can you tell the client how much the account value is going to be when they pass away? Not unless you're just saying today, if you pass away today, here's the value. But of course, the market hasn't closed yet today. Right? So in most life insurance contracts, not all because you have some variable performance embedded, but in most cases, you know exactly what the ending value is going to be. I believe there's some value to that. If we know the exact ending value, that might give us the ability to take more risk elsewhere, right? And by the way, if we know the known ending value and we realize that it's being guaranteed by a strong company like, say, Pure Prudential or John Hancock, and that it has no market risk or volatility, so no correlation. And if it's income tax-free and possibly estate tax-free, once again, this can be a beautiful asset that you can buy in a sleeve, right? So it's an asset class that's being ignored, but we go, hey, maybe we ought to have some of this asset class. And I'm going to describe that, give you an example in a minute. So touching the heart before you touch the mind, I've alluded to this, right? How I generally do that is I like to start with these kind of questions, especially the first question. This is the most important question in my opinion, which is, Mr. and Mrs. Client, what is important to you about your legacy? Because first of all, I'm not going to assume that something's important to them. And by the way, legacy is sometimes a big word and they don't really know what that is. Well, what do you mean? Well, what's important for you to leave behind, if anything? And is that just assets? Is it knowledge? Right? What's important to you? You start asking people about this, you'd be surprised what they might tell you. Okay. By the way, if nothing is important to them, that's really meaningful for us to know as well, right? Because if nothing is important to them and they want to spend their last dollar, well, how important is it going to be for them to maximize estate value or minimize taxes? Maybe not. So there's no wrong answers, but what's important to you? And then, by the way, now that you told me that that's important to you, you want to make sure that your kids split $1 million, for example, right? You want to make sure no matter what, that you get $500,000 for each person, if that's the answer, right? I made that up. It also fits into the example I'm going to give you. You go, well, how would you feel if you weren't able to do that? No right answer, right? But how would you feel? And then do you want to learn some strategies that would help ensure that we could make that happen? I learned in the last year or so from a colleague of mine who starts asking the last question. Would you rather guess or would you rather know? I think that's a pretty powerful question. Now, I'm invested in the market, and to a certain degree, I have to guess what's going to happen and how I'm going to perform. That doesn't mean that I have no idea how it might perform, but I do have to guess. And what I really know is what? I'm going to pull up the ICA chart, and it's the yo-yo going uphill, right? That's what I know is going to happen. What I'm guessing is when and how. Well, would you like to guess or would you like to know? You might be surprised. Some people don't want to guess at all. No, I want to know. It's so important. I want to know. Well, maybe we should utilize a professional money manager and a professional risk manager called an insurance company that could guarantee that this will happen for you. And then we can look at the math and find out, is that a good deal? If someone's willing to guarantee that, they're going to give me a good deal. You might be really surprised how good the deal is. Okay, so here's the case study. So you got 65-year-old clients, in this case, trying to put a $1 million death benefit in place. And they want to provide $1 million tax-free. We're showing a standard plus rate class here with Prudential. That's because Prudential and John Hancock are well known to issue standard plus rates where the market would issue standard rates. It's part of their competitive advantage. Part of it's them being so big. If you've been on these calls with me before, you know that I'm hesitant to ever show preferred and certainly super preferred rates. Our clients get preferred and super preferred rates. I just don't think it's a good idea to present those. It anchors an incorrect assumption. And by the way, it is difficult to get those rates, but I think it's fair at standard plus because this is really standard across the board. And understanding that when you use a second to die policy, you're probably aware they underwrite both spouses, and one spouse might be super preferred, the other might be class 2, and they kind of blend these in. So this example is standard plus and standard plus for both of them. Excuse me. All right, so what you have here is you have an $18,000 annual premium. Let's stop there. Holy cow. You just asked grandma and grandpa to pay $18,000 for insurance that they don't need. Okay, so we're going to pause there, right? That's a lot of money. Even I agree that that's a lot of money. 18 grand. But this doesn't cost 18 grand. See, right there, we're already wrong. Okay? So first of all, grandma and grandpa don't need this. They want this. And why do they want this? Because their legacy is important. They want to make sure that $1 million exists no matter what. They don't want market risk, and they want tax efficiency. Okay? Well, $18,000 a year is buying an asset worth $1 million. $1 million of death benefit. Now, is that a good deal or a bad deal? You see this IRR at death. So IRR is internal rate of return. If in year one you put $18,000 into this asset and both people die in year one and $1 million is paid out income tax free, that represents a 5,400% return. In a 35% tax bracket, that's the equivalent of 8,300. Okay. Now a couple comments here. First of all, that's a real number. That's a real number that's guaranteed by Prudential. The likelihood of the husband and wife in this example of dying in year one is very, very close to zero, but not zero. They were underwritten after all. But to the extent they get hit by the proverbial bus, what you have here is you have the best performing asset that your client has ever invested in ever. And I'm serious, right? I'm not trying to be weird. I'm saying mathematically, if you turn $18,000 into $1 million in 1 year, that's a huge return, and it's beautiful. Now we had to die to get that return. I understand this. But where I'm coming at is people are like, well, this is garbage. It's 18 grand. It costs too much. No, it doesn't. Okay? In year one, 18 grand turns into $1 million. Now, Rod, be fair about this. And I am going to be fair. These people aren't going to die in year one. They're probably not going to die in year 10. They're probably not going to die in year 20. Now, by the way, it's both people have to die in order for this to pay. So one person could die early, one person stays alive longer. Let's go out 20 years. So now they're joint age 84. Now they've put in $362,000 into this thing. Boy, it's super expensive. I put $362,000 in this thing. Yes, you have. What happens at death? $1 million. What return is that? 8.91% return. That's a better than equity return with no equity exposure and completely income tax free to the heirs. And to the extent this is in an irrevocable life insurance trust, then it's also estate tax free to the heirs. In a 35% tax bracket, the equivalent is 13.71. Yeah, Rod, but you got to be fairer than that because they're going to outlive that. And I agree, they probably will. Now, some clients won't. Some won't, but they probably will. I agree with you. So we go out 30 years. Well, my experience is that most of you that are running financial plans are running financial plans out to joint age 95. And so I think that that's probably a reasonable expectation. So if we go out 30 years here, well, guess what? They've had to put $543,000 into this thing. It's so expensive. No, it's not. $543,000 went in, we get $1 million out. What's our return? 3.68%. Now, do I think someone needs to jump up and down for joy on a 3.68% return? No. But it's a 3.68% return that's guaranteed, non-correlated, and income tax-free. Is that better? What would you have to get in the market? What kind of risk would you have in the market, right? And by the way, this will perform much better at earlier years. So people throw this out with the proverbial bathwater because they don't need it, and 18,000 is too expensive. But I say, well, you have 18,000 already. It's either going to be in pocket A or pocket B. If we put it in my pocket, pocket B, your 18 grand turns into $1 million at the triggering event, right? Both are dying. By the way, why are we doing this? To help increase liquidity. And so you start looking at it like this and you go, wait a minute, how can they even do that? Right? Some of these clients who have this policy are going to die in year 20 and the insurance company is going to pay them 8.91%. How is that possible? The insurance company cannot afford to pay that return, right? Wrong. They can afford that because what they've done is they've placed this on 1,000 different couples. And by the way, when they do it that way, they know how many are going to die in year 1 because one of them is, in year 2, and year 5, and all the way down. And that's what insurance is. It's a risk sharing. And so the insurance company is able to be wrong with these clients. They're able to pay these clients 9%, right? And why is that? Because some clients are going to live much longer and they're going to pay a smaller amount. So they get to take bigger risk, right? And that I think is really important when we talk about our clients having, pick a number, $3, $5, $7 million, let's say. I would say, generally speaking, clients who have $3, $5, $7 million and are retiring are in a very good position. And they can probably take some pretty good down years if they have to. They can make some mistakes. They might even be able to get ill, if you will, mathematically. Okay, but that's not nearly as much wiggle room as insurance companies, right? The insurance companies that we bring to play sit on reserves, oftentimes in excess of $80 billion or more, just set aside to specifically pay future claims. So they're set up to be able to take more risk than us, which is why if we're touching the heart, what you're going to find is some people hate risk. And hopefully you're already asking about risk, and I'm sure you are through the asset allocation. If you start asking people, what mistake would you rather make? Right? This stuff's kind of expensive. I don't think I want to put that in place. Well, would you rather put it in place and not need it? Or would you rather need it and not have it in place, right? We got to get into the heart on these matters. Okay, so this would be what would happen if we're trying to fund $1 million contract. Now there's ways that we can make this even better, and it depends how a client is situated and where their dollars are. Well, instead of maybe paying $18,000 a year each and every year, what we could do is we could supercharge this idea by funding an annuity with a one-time lump sum that spits out a lifetime income forever of this $18,000. And when we do that, we get even more leverage. So let me tell you what I mean. So the two of them would require about $273,000 one time in an annuity product that would spit out a lifetime income of the $18,000 that we need to fund the life insurance. So now instead of them picking up an additional cost in their budget in retirement, all we've had them do is reposition part of their portfolio. By the way, if they have a $500,000 portfolio, are we talking about this? No. These people probably have $4, $5, $6, $7 million likely, maybe more. So we're carving out a portion of that, right, as the funding vehicle. So we pull aside $273,000, and then it's going to pay this $18,000 every single year, right? And so what we end up having here is earlier deaths create a bigger windfall from a liquidity standpoint. Like what happens in year 1 if death occurs? Well, we still have $263,000 of death benefit that remains inside of this annuity at that time. So you get the $1 million death benefit and you get the 263 here. You get out 20 years and the same thing happens, right? Here's the age 90. Death occurs at age 90, we still have 95,000 in here. So you get $1 million plus this 95,000. And so this can be a really great solution for your clients that have a non-qualified annuity that's kind of hanging out there. Maybe you placed it for them, maybe you didn't, but it's just kind of out there. And it's not really in the income plan. They don't really know why they have it or why they need it. That could be repositioned to be the funding vehicle to fund the insurance strategy that we just described. Right? Another way that that could come from is the lazy, my words, the lazy whole life contracts that are out there. You run into, the person who has the 5 Northwestern Mutual policies that are sitting out there that has $60,000 of cash inside of them. They don't really need the life insurance anymore. The cash value, they don't really view as real. It's not inside the retirement or the retirement timeline for using that asset. Well, those assets can be repositioned. Remember, you can 1035 from an annuity to an annuity. You can 1035 from a life insurance policy to an annuity. What you cannot do is go from an annuity to life insurance. So there's a lot of opportunities for some interesting planning here. As you can expect too, when you put this in, now you've generated revenue twice, right? You got the life insurance commission and also the annuity side as well. So this can be a good way to increase leverage there. So if you have questions on this kind of concept, reach out to Andrew, reach out to George, reach out to myself. Opportunities for this strategy, we kind of address most of these, the illiquid estates, whatever that might mean. It could be the closely held businesses and farms, right? That concentration risk. We did a Coach's Corner last month about business owners and how important it is to really review their biggest asset, which is their business. And so a lot of our clients who have these closely held businesses are effectively like micro stocks. And you would never put more than 5% and maybe not even close to that much in a micro stock inside of your overall portfolio. But a lot of times our clients have a bulk of their net worth there, right? Plus their ability to earn an income. So they could lose their ability to earn an income and the asset, right? So just really understanding that and protecting that. Large IRAs with unwanted RMDs. The strategies, we showed you 65-year-olds, you can do that at 70, you can do that at 75. You start getting older than that, the math maybe doesn't work quite as well, but it's really the health. The health is really the issue. We don't generally get healthier in life, right? So we have these conversations as early as we can. You got clients who want to make charitable bequests, right? Hey, I give $10,000 a year every year to big brothers, big sisters, for example. Well, that's great. Well, how do you feel about what's going to happen when you pass away? Is it important to you to maintain that? What's your thought? Well, yeah, I haven't really given that a thought. Well, maybe that person in that example could give a current gift of $5,000. Maybe they could take the other $5,000 and buy a life insurance policy where the charity is the beneficiary, right? And then they can have a gift after they're gone, perhaps, right? So that would be a way that you could use an asset like that or institute some sort of charitable remainder trust. There's a lot of different strategies there, but we have to ask the right questions. The wrong questions are, do you want insurance? Because that answer is no, right? So we're going to ask what they do want, and ask if they want to learn about how insurance could potentially be a solution and understand the pros and cons, right? There's always pros and cons. Then it could also be long-term care estate replenishment, meaning some people choose not to have life insurance in place, but if they have let me restate that. They choose not to put long-term care insurance in place, thinking that they're going to self-insure, but if they get shrunk down from the cost of long-term care, the death benefit can often replenish part or all of what was pulled away. So those would be different ways that you could utilize a similar structure like I've just described. Okay. So what about these clients and what are their options to put long-term care coverage in place? Right. And again, we've done Coach's Corners in the past where we'll go a deep dive on this side. This is just going to be a snapshot, putting together kind of what I consider to be a 4-lane highway. But even relative to long-term care, people always think that their only option is traditional long-term care, which I call the use it or lose it, pay-as-you-go plan, right? And the premiums aren't guaranteed, and the claims are reimbursement based, and so we've had clients, and maybe some of you have had clients that have had increases even approaching or in excess of 100% increase over what their original premium was. Well, there's more than that way to deal with this. We can use life insurance contracts, we can use annuity contracts with long-term care riders as well. And so a quick snapshot on that for this 65-year-old couple here. Securian is the first line, so we would call these a hybrid accounts that are both life insurance and long-term care together. We have multiple carriers in this space, including Lincoln MoneyGuard and Securian, and Nationwide would probably be the 3 that are biggest in this space. What I have snapshotted here is a $4,000 monthly benefit for 4 years with a 3% inflation rider. So if death occurs, we get a $96,000 death benefit if no long-term care has been taken. But if we need long-term care, we have $4,000 a month times 4 years, which is about $196,000 on day one. And then we have a 3% cost of living adjustment on that long-term care bucket moving forward. And so we can reposition a one-time premium of $92,000 for the gentleman here and $104,000 for the woman, and effectively get all of these values guaranteed and paid up by the company. And we can also do that on a 10-pay basis. I call it a mortgage, right? There's no such thing as a mortgage, but instead of paying $92,000 a year, we might be able to pay $9,500 maybe for 10 years, right? And so a lot of that goes to custom designing solutions. I talk to clients all the time that what we're really attempting to do is custom design a solution for you based on your risk tolerance, based on your retirement portfolio, based on how you could fund this plan. Do we have a lump sum that we can reposition, and does that make sense? If it's invested in the market, well, what happens if we pull that out? Now we have missed opportunity costs. Maybe we ought to keep it in the market, and maybe we ought to take some of the interest or dividends to pay for it. So there's a lot of different ways to deal with that. One America, the second piece there, that's a joint policy. That policy is, again, solving for $4,000 a month with a 3% inflation rider, but you can only get 66 months of coverage in this design, and it's a shared coverage. And that death benefit of $133,000 is only payable at the second death. But we can take a one-time lump sum of $162,000 and protect both of these people. Now that product, as illustrated here, uses non-qualified money for this $162,000, but One America has a beautiful program where you can take qualified money. So you could take $162,000 of the qualified money and effectively roll it over into a qualified annuity. That qualified annuity then will take that $162,000 and push out 10 years of income, which is taxable to the client. They'll send a 1099. So now we're stretching this out 10 years. So it's a rollover, and then the annuity is paying out for 10 years. As the annuity is paying out for 10 years, you're buying a life insurance and long-term care plan together that is creating these benefits. And so that's the idea of, okay, well, clients want to address this, but they really don't have the cash flow to do that, but they have these large IRA balances. Maybe we ought to reposition some of that. Are we repositioning $162,000 out of a $500,000 IRA portfolio? Probably not. Right? It's probably much bigger than that. Although maybe, because where we see that would be like the two teachers that have nice pensions. Maybe they're 80 grand a piece. So they got $160,000 of income. Maybe they have Social Security, maybe they don't, depending on their state. But then they might have these 457 plans, right? And they might have $300,000 in each of them, but they don't need it for the income. That's sort of their long-term care fund. Okay, if that's your long-term care fund, what if we just repositioned 100,000 of it? What would that look like? Right? So hopefully you guys are understanding that it's not always what you say, it's how you say it and what is the context, right? And insurance is just math. It's really all it is. And people are looking at the wrong math because they're just looking at these numbers going, $7,000 a year, are you out of your mind? $92,000 lump sum, no way. We got to have the right context. Right? So that third bullet point, protective, there's a number of carriers in this space where you effectively have what I'd call a regular life insurance contract, usually a universal life, sometimes an indexed universal life, that it creates a death benefit or a long-term care advancement. So you can buy a $200,000 life insurance policy with a 2% long-term care rider, which allows you to pull forward $4,000 a month for 50 months. $4,000 a month times 50 is $200,000. So what's neat about this particular type would be you're guaranteed $200,000 one way or the other, either through death, through long-term care advancement, or some combination thereof. Right? And again, this can be good for those old lazy whole life assets. Well, we've got $45,000 of cash value. Well, maybe we ought to reposition that cash value, either to pay up a policy with a one-time payment, or maybe serve as a down payment to pull this $7,000 premium down. It's worth noting, and many of you are probably aware, that generically it costs more for women to buy long-term care than it does men, and it costs more for men to buy life insurance than women. And that's because women outlive men by 5 to 7 years on average, and they use long-term care at a higher rate. Okay. The last two bullet points there are Mutual of Omaha and their traditional long-term care, one of which has a shared care rider. Shared care riders are pretty cool. So if husband has a 4-year benefit and wife has a 4-year benefit, and husband goes through his 4 years, he can go into his wife's bucket over here. And in fact, he can take 3 of his wife's bucket or vice versa. So the way the shared care works is that you can use all of your bucket and most of the spouse's bucket. You have to leave 1 year in the bucket for the spouse. And so this is helpful when actually presenting long-term care, this kind of structure, I find, because we can compare and contrast. And just like some of you probably went, yeah, I don't like that structure on one of these. You probably said, yeah, I don't like number 1, I don't like number 3. Same thing happens with clients, and I plan on that. What I understand about people relative to buying insurance, and it might be just people in general, I don't think they know what they want that much. I think they know what they don't want. And so we'll say, okay, well, let's put an X through the one that you don't want to, because this can get kind of confusing. And what we want to do is we want to narrow down our options, right? And so I ask people to say no before I ask them to say yes. Right? And I think that helps a lot. And it's allowed me to get people out of what I consider to be, and it was told to me about being paralysis by analysis. I don't know if that's ever happened to you personally or with your clients. You give them too many options, their eyes are glazing over, they want to think about it, they end up being paralyzed. And so part of what we do is we go, well, if we're not really going to consider that lump sum structure, let's not even go into the weeds on it. Let's just move it to the side. There's too much, clear the deck, and then we can go deep. All right, we're wrapping up in the next couple of minutes here. Before I do that, I want to show a microsite that Prudential has that's really, really cool, and it's geared directly towards the estate tax rollback that's occurring January 1, 2026. And so they've put together mammoth resources around this in particular to give you all kinds of solutions to be able to talk with your clients between now and then. We're encouraging you to not wait. Now is the time to be talking to them about these changes that are occurring for many reasons. And so we don't have time to go through these, but I want you to know that there's some really cool stuff in here. They've got great client profilers. They've got great pieces on what is an irrevocable trust and what does that look like. These are client approved. And again, reach out to us. We'll hook you up with these. Prudential is a big leader in the estate planning environment more than anything. Like they place a lot of second to die policies, and they place a lot of huge policies. Prudential is just enormous, and that also is why they can take on a little more risk than other companies can, which is why they tend to be one health class better than everybody else, which is why I showed you Standard Plus on that basis. Right? So with that, George and Andrew and myself will be happy to help you on your next case. We do have our next coaching call on April 18th at 1 o'clock. You see in the red there, I'd like to ask you, if you're not having this kind of conversation with your client, is anybody having that conversation with your client? And then if they are, what does that mean, right? I think Philip used to work with us, Philip Simonson, and he taught me that our clients are other people's prospects. Right? And so we want to do the best job. We want to have a comprehensive job. We want to be doing the best work that we can, right? And protecting from shrinkage, maximizing estate value, et cetera. So I know many of you work with Andrew and have his contact information. I've got that here up on the screen. And we also have George's. And so, with that, again, try to join us on April 16th. To the extent you want to see any of our past presentations, reach out to us on that. I hope your bracket isn't being busted this afternoon as we start with March Madness. So with that, I'll wrap everything up. How we do our Monday morning meetings, which is let's be great leaders for our clients. Let's help our clients, and let's drive revenue to our practices. So I appreciate you guys. Have a wonderful day, and we'll catch you next month. Take care.